today's event, Now to start today's event, our first speaker is the Director and Portfolio Manager of Highmark Capital Management and has more than 22 years of investment management, investment banking, and public accounting experience. He's received a Bachelor's of Arts degree in Economics from the University of California at Santa Barbara and a Master's in Business Administration with an emphasis in Strategy and Finance from UCLA. He is a CPA and a member of the CFA Society of Los Angeles. Please welcome Todd Lowenstein.
Can you hear me okay? Too loud, or is it just right? Great. Well, it's a pleasure to be here with you today. Thank you for having me. It's a delight for me, and look forward to your questions and interaction. Let's make this as interactive as possible. I know we've dedicated about 10 minutes at the end for Q&A, but feel free to ask questions throughout. I thought I'd start off today just with a quote, because I have quotes, and you'll see that throughout the presentation, which I think gets to the heart of what we do here. And there's no doubt that value investors, I think you'll hear today from the panel of people, are a different breed of investor. And I think a great quote captures the essence of what I'm talking about here. It goes something like this. In most trading rooms, you can tell by the buzz of the room whether the market is up or down for that day. Whereas in a value investing office, you can't the market's open. There's a lot of truth to that, and it speaks to our constitution and what we pay attention to and what we don't pay attention to. We find that we are mostly grounded in business fundamentals and business valuations, and not so much in the day-to-day gyrations of the market. Now, there's no doubt that value investing is also probably less entertaining than other styles of investing, like growth investing or momentum investing. But yet it's proven to be more successful. I'm going to show you that to you with some empirical evidence. So the question is, why don't more people do it? And I'll quote Warren Buffett here. He gave an example here as to why some people just don't have the constitution for it. He said, value investing is like an inoculation. Either it takes or it doesn't. And the true test is, if you have a need for action. Can you hear me okay?
Test. Use this one.
Would you prefer this?
Without the speaker, please.
What's that?
Without it.
Without this? Okay. So he said value investing is like an inoculation. Either it takes or it doesn't. Either you get it or you don't. And the true test is, if you have a need for action and want to be involved in the most exciting industries of our time and the biggest breakthroughs, you're probably not a value investor. And the reason is, those investments, those companies tend to sell at a big premium to the market and carry very high expectations. Most value investors fish from a completely different pond altogether. We fish from the pond of companies that are undervalued, unloved, mundane, and frankly have low expectations. So different area of the universe altogether. And heeding his advice, I hope to successfully inoculate you today on the virtues of value investing and why we think it's a philosophy and not so much a style, and can be successful in all investment seasons, including the current environment. How's it sound? Okay? Am I projecting well enough? Good. Just quickly, a quick agenda here. I'm going to give you a quick intro on the company I work for, Highmark Capital Management, revisit the principles of value investing in general, talk to you about how we apply them in terms of our philosophy and process, and then talk to you about our strategy, portfolio positioning, and even some stock selections. Not that I'm recommending them, just representative holdings of what we own today. First thing, Highmark Capital. Highmark is an investment boutique. It's been around for some time, since 1919. We have about 70 professionals. We manage about $17 billion in assets across equities, fixed income, money market, and across the retail channel, institutional, high net worth as well. We are a wholly owned subsidiary of Union Bank, which is in turn owned by Bank of Tokyo and Mitsubishi. Enough about that. Let's go into value investing. I'll talk to you about why it is a successful strategy, and the question is why value? I'll get to the punchline immediately. Because it works. You get more return with less risk, and that's what the empirical evidence has borne out. On this chart here, you have an example comparing Russell value versus Russell growth going back to 1975. I think it's about 35 years. And you can see here it's outperformed pretty significantly on a cumulative basis, which is the graph right here, and then on an annual basis there. And so essentially it's outperformed by about 2.5% annualized over that time period, which on a cumulative basis compounds, basically is 2.5 times more money at the end of the day. You also observe less volatility, so less inherent risk. So more return, less risk, better risk-adjusted returns. That's not to say there are not great growth managers out there, because there certainly are that crush it and add value. And it's not to say there's not bad value managers out there, because there's those too. But on average, these styles, the numbers bear out that value is kind of, from a strategy standpoint, probably the preferred approach on average. Let's talk a little bit just about philosophy. I think it's important to set the framework and foundation about how we think and how we go about business each and every day, especially amid all the cross currents out there and macro event risks that we constantly see. And I want to just revisit some of the principles for you. So first, most value investors are patient, they're contrarian, and they're long-term in nature. And much like discount shoppers, always looking for the best qualities they can possibly find. And stocks we buy, as I mentioned, tend to be the mundane, the unloved, misunderstood areas of the market. And it's generally not uncommon for us to take an out-of-consensus view. Not because consensus can be wrong, which it can be, but most likely it's already priced into the securities because everybody knows about it. So we think our competitive advantage, speaking to a long-term perspective, is thinking long-term, and we call arbitrage and time horizons. The market is focused, it's myopic, it's obsessed with the short run, the news cycle, the event of the day. We focus on long-term fundamentals, business values, business fundamentals, industry characteristics. And essentially what we try to do is arbitrage those time horizons and take advantage of them under the assumption that over the long run, the short run and long run are going to converge. And ultimately what's going to happen is the short run is going to converge to the long run. So it's kind of the old Wayne Gretzky quote, skate to where the puck is going, not where it is. We skate where the puck is going. We think that's the long run, focusing on the right things as opposed to the wrong things. The second concept is really this notion of a business owner. We think like business owners and expect our companies to operate similarly. And not so much thinking about tickers on a screen or ownership of shares, but a real business. And we judge management's ability to be two things. One is good operators of a business, but also effective capital allocators, because those two things really drive company value over time. We also believe in low turnover with a long holding approach. We generally hold stocks on average 3 to 5 years. Big believer in the notion of compounding. You probably know the old quote from Einstein. He was asked, what is the most powerful force in the universe? What did he say? Compound interest. Compounding is a very powerful force, and you can find stocks selling at big discounts what they're worth and hold on to them. Let the compounding forces and impact work in your favor. Things can work really well for you. The third notion is intrinsic value. You probably heard a lot about intrinsic value. Value investors talk about it all the time. And people define it differently. And in the next slide, I'm going to go into a little bit how we define it. But it really is the centerpiece of most people's strategies, to focus on what a company is worth, comparing it to the price in the marketplace, seeing that there's a big, basically being interested when there's a big gap between price and value. And that occurs generally, value investors are very interested. And we take a very holistic approach because, as I mentioned in the intro or the tagline, valuation is part art, part science, and frankly involves a high degree of judgment. So I'm going to get into a little bit of that in a moment. Third concept is margin of safety. You've probably heard about this as well. It's very important, because the future is unpredictable. We require a margin of safety to protect ourselves from adversity and a fixation what can go wrong. And attempt to buy at a low enough price, a low enough multiple valuation, so you're protected. And essentially, you're playing defense here. And it's kind of like a sports analogy. Defense wins Super Bowls, right? If you buy a low enough valuation with low enough risk, you stack the odds in your favor. And I think it was Ben Graham or Warren Buffett, or both, would say, if you take care of the downside, the upside usually takes care of itself. And so focusing on the downside is just as important, trying to hit those home runs out there. In fact, it behooves you probably to focus more on the downside.